Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Hello and welcome back to the channel. Today, we're diving deep into a fascinating microcap stock that recently popped up on our hard-to-borrow screener, TGHL. We're going to break down exactly what makes TGHL so unique in the world of short squeezes, even with its unusual current trading profile. So let's talk about TGHL. This is a micro-cap stock, and interestingly, its sector is listed as N/ in our database. Now, let's look at its recent price action and volume, which is crucial for understanding its current state. Today's change for TGHL was plus 0.0%. Over the last 5 days, also plus 0.0%. And looking back a full 30 days, we see plus 0.0%. What's even more striking is the volume. Today's volume was 0 shares. The 30-day average volume is also 0 shares, leading to a relative volume of Xerox average. Yes, you heard that right, 0 trading activity. But don't let that lull you into thinking there's nothing to see here, because the cost to borrow data tells a completely different, and very compelling, story. What is cost to borrow and why it matters? First, for those new to this, let's define cost to borrow, or CTB. When an investor wants to short a stock, they first have to borrow shares from someone who owns them. They then sell those borrowed shares, hoping to buy them back later at a lower price and return them to the lender, profiting from the difference. Show animation of short selling process, but borrowing isn't free. The cost to borrow is an annualized fee, essentially interest, that the short seller pays to the lender for the privilege of holding those borrowed shares. When a stock is hard to borrow, it means there's a very limited supply of shares available to short. This scarcity drives up the borrowing fee, often significantly. Fees can easily exceed 100% annualized, meaning a short seller could pay more than the stock's entire value in borrowing fees over a year. It's a direct signal of demand versus supply for shorting the stock. Why the stock is hard to borrow right now. Now, let's look at TGHL specific numbers, and this is where it gets wild despite the zero trading activity. TGHL appeared on our screener due to an astounding cost to borrow fee of 798.8% annualized. Show text on screen, CTB 798.8%. Not only is that number incredibly high, but the CTB momentum has also exploded, rising by plus 294 percentage points over just the last 5 trading days. This indicates a dramatic increase in the difficulty and cost of shorting TGHL very recently. What's more, the shares currently available to borrow are a mere 40,000 against an estimated float of 12.7 million shares. That's an extremely tight supply. Our internal composite squeeze score, which factors in all these elements, currently sits at a very high 70.7 for TGHL. The paradox of zero volume with such an extreme cost to borrow implies that either the few existing shorts are trapped and cannot easily cover, or that any new short interest is extremely difficult and expensive to establish. Squeeze mechanics explain. So, how does this set the stage for a potential short squeeze, even with no current trading? A short squeeze happens when a stock's price starts to rise, forcing short sellers to buy back shares to limit their losses. This short covering creates buying pressure, which in turn pushes the price even higher, trapping more shorts and forcing even more covering. It's a vicious cycle for short sellers. Show animation of squeeze. With TGHL's 798.8% CTB and only 40,000 shares available to borrow, if any real buying pressure were to emerge, even small amounts initially, it could rapidly ignite a squeeze. Short sellers paying nearly 800% per year are under immense pressure, and any upward movement would likely trigger panic buying to close positions, especially given the tiny borrowable supply. Dilution risk check. One crucial factor for any potential short squeeze is dilution risk. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. While this can provide capital for the company, it also spreads the existing value across more shares, which can depress the stock price and often negates the short squeeze thesis. More shares available means it's easier for short sellers to cover their positions, or for new short positions to be established without driving up borrowing costs. For TGHL, our check found no recent dilutive SEC filings such as -1, -3s, or 424 BS in the last 90 days. We also found no recent reverse splits for TGHL in our lookback window. This is a positive sign for the squeeze potential, as there's no immediate threat of new shares flooding the market to offset short covering pressure. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what does this all mean for TGHL? While an almost 800% cost to borrow is a screaming signal of scarcity and short pressure, it's vital to remember that a high CTB does not guarantee a squeeze. It can also signify that short sellers have very strong conviction in their bearish thesis and are willing to pay enormous fees to stay short. This is particularly relevant for TGHL, given its current lack of trading volume. With 0 shares traded in recent periods, there is no current price momentum to pressure short sellers. For a squeeze to ignite, we'd need to see a significant shift, a sudden surge in trading volume, even modest upward price movement, and a further shrinking of that already tiny 40,000 share borrowable supply. Without any actual buying pressure, the high CTB remains a fascinating data point, but not an active squeeze catalyst. Keep TGHL on your watch list, but understand that it's currently a dormant powder keg awaiting an igniter. TGHL presents a truly unique situation, a micro-cap with in/a sector 0 trading volume but an extreme, rapidly increasing cost to borrow. It's a perfect case study for understanding the mechanics of hard-to-borrow stocks and the potential for a short squeeze under the right conditions. Will TGHL eventually see the trading volume needed to unlock its short squeeze potential? Only time will tell. If you found this breakdown of TGHL insightful, please hit that like button, subscribe for more unique stock analysis, and let us know in the comments what other hard-to-borrow stocks you'd like us to cover next. Thanks for watching.